Before we begin, if you value understanding the hidden mechanics shaping your financial world, take a moment to subscribe. We explore these stories every week, calmly, clearly, and without noise. Picture this for a moment. May 6th, 2010. A normal trading day. Quiet, routine, predictable. And then, in less than 20 minutes, over $1 trillion in market value vanished. Not because of a war, not because of a global disaster, but because a machine, an algorithm, saw something it didn't like and reacted faster than any human on Earth ever could. This event is known as the flash crash, one of the most dramatic, terrifying moments in modern financial history. Buy orders disappeared, liquidity evaporated, blue-chip companies momentarily traded for just a few cents. Chaos rippled across the screens of traders everywhere. And here's the part that still haunts the financial world. No one understood what happened until long after it was over. Now fast forward to today, where the algorithms aren't just faster, they're smarter. They don't simply follow rules anymore. They learn, they adapt, they explore patterns hidden from the human eye. Artificial intelligence has quietly taken command of the market's pulse. Millions of micro-decisions, thousands of data streams, executed at speeds the human nervous system can't even comprehend. And that raises a question most people never think to ask. What happens when the world's financial system is driven by something that doesn't feel fear, but can instantly create it? Because here's the truth. AI doesn't just react to the market anymore. It shapes it. It nudges it. Sometimes, it manipulates it. From high-frequency trading algorithms that operate in 1/1,000,000th of a second, to deep learning models that scrape social media sentiment across Twitter, Reddit, TikTok, Discord, it's become the invisible force pulling the strings behind the curtain. And when these systems collide, when one model misreads another, or two trading algorithms lock into a feedback loop, the results can be catastrophic. The flash crash was a warning shot, a glimpse of a future where the market doesn't crash because of humans, but because of the machines we built to outsmart one another. This is the dark side of AI in finance, the side no one talks about, but everyone feels. To understand what comes next, we need to look at how this entire system evolved, from the birth of high-frequency trading to the moment AI began making decisions not even its creators fully understand. To understand how we reached this moment, we need to go back to the birth of a creature Wall Street never fully tamed. High-frequency trading, HFT, a system built not on strategy, but on speed, not on long-term vision, but on microscopic opportunities measured in microseconds. In the late 2000s, something extraordinary happened. Firms like Citadel, Virtue, and Jane Street began building infrastructures that resembled military operations more than financial companies. Microwave towers stretched across the American Midwest. Underground fiber cables were laid in perfectly straight lines. Servers were placed physically closer to stock exchange computers to shave off a fraction of a millisecond. Why? Because in the world of HFT, a millisecond isn't time, it's money. These firms discovered a simple truth. If you can react faster than everyone else, even by the smallest slice of a second, you can see the market before the rest of the world does. Buy before others buy. Sell before others sell. Profit before others even realize what happened. At first, this system was predictable. Algorithms followed strict rules. If X happens, do Y. If price rises, react. If volume drops, adjust. Humans still understood the logic. But then came the second evolution, the moment the machine began to learn. Artificial intelligence entered the arena, and everything changed. No more simple models, no more rigid rulebooks. AI models started analyzing social media posts, macro news, market psychology, Google search trends, Reddit threads, even the emotional tone of tweets. And with each piece of data, the models grew more aggressive, learning which signals move markets, which words trigger panic, which narratives create momentum. This is how the modern AI manipulation engine works. Step 1. Scrape millions of signals from the internet. Step 2. Build a map of investor emotion in real time. Step 3. Execute trades so fast that human investors aren't just too slow, they're irrelevant. Today, over half the daily market volume is generated by machines talking to machines. But here's the part almost no one understands. When AI systems read the same data at the same time, they can loop into each other. One model buys aggressively, another model reads that as a trend, another amplifies it, another follows. Momentum spirals upward, or downward, in seconds. This is how artificial intelligence can unintentionally create panic from nothing. A tweet, a rumor, a misinterpreted pattern. AI reacts instantly, then another reacts to the first reaction, then a third reacts to the second. It's not manipulation by design, it's manipulation by accident. And sometimes, it's not an accident at all. Some models are built specifically to detect and exploit herd behavior. They push prices upward just enough to trigger emotional retail buying. Then they dump the position seconds later, leaving human traders holding the bag. Pump and dump, but automated. Legal? Not exactly. Illegal? Hard to prove. A gray area where machines break rules faster than regulators can write them. This is the world we now live in, where financial markets operate at speeds that human intuition can't keep up with, and decisions are made by systems that even their creators don't fully understand. And the deeper you look into it, the more one question becomes impossible to ignore. If AI can move the market, what stops it from breaking the market? So, what does all of this mean for the ordinary investor? For the person who isn't running billion-dollar algorithms, who doesn't have access to high-speed infrastructure, who isn't connected directly to Wall Street's nerve centers? The first truth is uncomfortable, but it must be said clearly. In a market dominated by AI-driven institutions, the individual investor no longer competes on speed. Not even close. You can't beat machines at reaction. You can't beat them at pattern recognition. And you certainly can't outtrade a system that digests the entire internet before you finish reading a headline. But that doesn't mean the game is unwinnable. It just means the rules have changed. The second truth is this. AI has created a market with two realities, one for institutions and one for everyone else. On the institutional side, AI systems operate like financial exoskeletons, augmenting human decision-making with deep learning models, sentiment extraction, predictive analytics, and reinforcement learning trading engines. These tools don't just observe the market. They shape it, they bend it, they influence volatility in ways that traditional models could never anticipate. Meanwhile, the individual investor faces a different battlefield, one where prices can move violently for reasons that won't appear on the news for another 12 hours. One where AI-generated volatility creates sharp swings that look like opportunity but are often traps. This is the paradox of the AI era. The people who feel the most risk are the ones who control none of the algorithms driving it. But here's the part that matters, the part that determines whether you survive or get swallowed by the new system. You cannot win by fighting the machines. You win by stepping outside their timeline. Because AI is unbeatable in the short term. But in the long term, AI amplifies trends rather than creates them. It accelerates what was already true. It magnifies fundamentals. It exaggerates sentiment. It intensifies momentum. So the real strategy for individual investors is not to chase the noise, but to anchor to what survives the noise. Cash flow positive companies, essential industries, energy transitions, artificial intelligence infrastructure itself. Sectors driven by structural demand, not fleeting emotion. And there's another tool, a shield, in a sense. AI-driven analytics available to regular people. Sentiment dashboards, long-horizon models, macro trend systems, risk-filtering engines. These won't win a speed war with Citadel, but they will defend you against the worst outcomes of an AI-amplified market. Because this new era of finance is not just about algorithms, it's about the people who understand how algorithms behave. And that's the real edge, not trading faster, but thinking deeper. If this gave you clarity, stay close. We explore these hidden mechanics every week, calmly, clearly, and without noise. Welcome to Financial Room,